All we've looked at so far is the gross number and then the net number after tax. What we're going to do now is have a look at the opportunity cost and the real numbers after inflation of a 10-year career and compare them to each other. I'm going to send you this spreadsheet probably tomorrow. But what we've got here is the investment bank and every level in the career at the investment bank with the total compensation before tax. And we've done the same at the hedge fund. Now, let's start with the investment bank. There's the 10-year career and what you get paid. So we're assuming here that you spend 2 years as a financial analyst, contractor, 3 years as an associate, 4 years as a VP ED, and you actually make it to junior managing director. When you get the spreadsheet, you can put your own assumptions in. You can actually do it for any career, because the spreadsheet just works for any numbers. But you can put your own expectations in. The expectations there are a bullish expectation for a 10-year career at an investment bank. That's assuming everything goes really well. And you actually make it to the junior managing director by the time you're 31, 32. We've got the tax rates and the tax that you pay, and we've got the net here, which I've put in white font so you can't see them yet. But when I send you the spreadsheet, they'll be in black font. There's the hedge fund. There's the tax rates. So we've got hedge fund, 2-year, junior portfolio analyst, 4 years as the junior PM, it was actually longer, wasn't it? 1, 2, 3, 4, 5. 5 years as the junior PM and 3 years as the senior PM. That's very, very achievable. That's a standard career if you go to a $1 billion hedge fund. So we're going to compare a bullish expectation of a career at an investment bank and a standard expectation at a hedge fund, a $1 billion hedge fund. You got the tax here, tax rates and tax you pay. And again, I've put them in white. The difference between the hedge fund and the investment bank is that you have to reinvest a portion of your bonus into the strategy. And this is where it makes all the difference. So let's start with the investment bank. What we've done here is assumed that you leave university £30,000 in debt. If that's not the case, when you leave, if you get the spreadsheet tomorrow, just change it to 0. It won't make much difference, but just change it. See what happens. You can play with the numbers. We've also assumed that you actually save throughout your career, or at least in the first 5 years, 10% of your net salary. It's very unlikely that you will, but let's just assume that you do. We've assumed a risk-free rate of 1% and inflation at the official Bank of England target of 3%. There's your inflation-adjusted annual net salary. That's what you get paid, progressing over 10 years. We assume here that when you get to year 6 and you're the VP ED, that you start saving a lot more. So you actually start saving out of your 150 net, 50. Because you like to save. We assume that you pay your student loan down linearly. and it gives you the number at the of cash in the bank on an inflation-adjusted basis. You can't have a trading account because you work at an investment bank. That's one of the things you give up. You can't have a personal trading account. Everything has to go through the bank, and you have minimum holding periods, 40, 60 days, depends on where you go. We come back to that later. But basically, you're in debt till year 6. What do you think happens to your inflation-adjusted wealth over a 10-year period? How much richer do you get in 10 years by going to an investment bank on this career profile? Let's have a look. 340 grand. Unfortunately, at this moment in time, you simply cannot buy a one-bedroom apartment in central London for 340 grand. With inflation at that rate, in 10 years' time, you won't even be able to buy a studio apartment. You'll still be flat sharing. Or you'll have a mortgage. Because at this stage, obviously, you'll be able to put a deposit down on something, but you're going to need at least 75 grand to put a deposit down on something that's $500,000 to enable you to borrow the rest. That's on today's numbers. So you might be able to get a mortgage in year 7. Up until that level, you'll be flat sharing. Now let's have a look at the hedge fund. Exactly the same assumptions. But from year 3, you're reinvesting a portion of your bonus back into the fund. That's the assumption we've made. We've made the assumption that you're putting at least half back into the fund. What we haven't assumed, and you need to play with the numbers when you get it, is that the hedge fund actually keeps making a compounded return every year. So we've just assumed that that money doesn't grow. The fact that the hedge funds still exist 10 years later means that they're probably making money. So the number that you're about to see now, adjust it for, say, a 15 or 20% return per year and see what the number comes out as. It'll be much higher. Let's have a look at what happens to your wealth over 10 years if you go to the $1 billion hedge fund. $5.7 million. That's the difference between the two careers. If you go to the hedge fund for 10 years and you go on the standard career profile of the $1 billion hedge fund, you can end up with this or a lot more. That's going to buy you 18 studio apartments in central London, and you can rent them out to all the guys at investment banks. You can make even more. But there's also an opportunity cost in trading for yourself. Because the one thing that you give up when you go to an investment bank is you can't have a personal trading account. Everything has to go through the bank, and you have minimum holding periods. So you can't trade in and out if things go wrong. So we've got an example here of actually starting to trade with your own money when you're young, and what a 10-year situation can look like. So we can quantify objectively the opportunity cost, what you actually give up. This is what you give up. Has anybody had a personal trading account before? A spread betting account or CFD account? Yeah? So you understand what it means to deposit money on margin and get leverage. What you'll find when you trade in a spread betting account or a CFD account, you will deposit money into the brokerage account. That money is then collateralized, and the broker lends you money to trade with using that money as collateral. In indices in the UK, Europe, stocks and commodities, for UK mainland Europe citizens, you'll be given 10 times what you put in your account. In currencies, Forex, you'll be given 100, maybe even 200 times, typically 100. In the US, the margin requirement is a lot higher. So depending on the product, 33 to 50% to run overnight positions. But seeing as though we're in UK, mainland Europe, we can leverage a lot more if we want to. But in this example, we're saying we don't want to. We're saying no to the 10 times and the 100 times because it's risky. No professional traders leverage that much. They'll leverage in equities 4 to 5 times, commodities 4 to 5 times, currencies 6 to 8 times. That's a typical professional trader profile. Here we're assuming that we leverage 5 times. So imagine if you leverage 100 times, you put 10 grand in your account and you leverage up to $1 million. If that trade loses 1%, your money's gone. You'll get a margin call. The broker will call you and ask you to deposit more margin in your account to pay for the losses. We're not doing that here. We're doing what professionals do. That's for stupid retail traders. Professionals will leverage 5, maybe 8 in currencies. But what happens here in this example, if you put 25 grand in a trading account and you leverage 5 times up to 125 in year 1? Well, if you make a 20% return after inflation, so let's assume it's after inflation, so you actually make 24%, and inflation, let's say, is 4. So you're making 2% a month return on a 5 times leveraged trading account. Your margin doubles every year. And when you get to year 11, you've got 25 million pounds. And 20% net is not unachievable. It's not unrealistic. If you know how to trade properly, you can do that. It's nowhere near as hard as you think. But what does this mean for you guys? Well, here, after 2 or 3 years, if you trade for yourself, so we're looking at it one way round, looking at the opportunity cost and discounting it back and saying, would I like to give up 25 million now to go to an investment bank? Or you can look at it the other way round and say, well, if I made money and I wanted to go to an investment bank or a hedge fund, here I've got choices because my account's gone from 25 up to 100. So why the hell would you go and work for the investment bank? You might not even consider going to work at the hedge fund. If you make 100 grand in a trading account, or even 50, imagine if you're sitting here in year 2 and you've made 50 grand trading in 1 year. And you go into the investment bank or even the hedge fund for an interview. And they offer you the contract to become a professional trader. The contract you get from the investment bank is 40 grand. They don't interview you, you interview them. And it's the same with the hedge fund, because at this stage, you're sitting in the interview and you're saying, well, thank you for the 100 grand contract, but I'm going to make 100 grand next year trading because I just have to do the same thing. So why would I come and work for you? You're interviewing them. If you trade with your own money, it gives you choices. This sheet here is the example to 1 million. Trading for yourself, the first tipping point is basically here, where you have a huge amount of choices. If you carry on trading for yourself, the second tipping point is here, where you've made your first million from trading, and that happens in 63 months on that profile. It's actually very achievable if you know how to trade. So tipping point 2 is basically when you've made the first million from trading. At that point, you've got a lot of choices, because at that point, you can say, well, I might take £500,000 or 750 out of my trading account and buy a real asset like an apartment, property, whatever, for cash. And I'll do the same again. Or you might decide to just carry on and go all the way up to the 25. So it depends what you want to do at each stage. But at the basic level, tipping point 1 gives you lots of choices. You can interview the bank or the hedge fund. Like I said, I'll send you those numbers. But here's some other things that it does for you. The obvious one is you make money. You'll like doing it. It's a nice feeling when you turn 50 grand into 100 for the first time, because it gives you choices. The next one we've just discussed, you interview the bank or the hedge fund. You now have the power. They don't interview you as a candidate. They interview you as a peer. If you decide to go to an investment bank, if you've got the ability to make money trading yourself, you can go to the investment bank for 2 years and use them before they use you to learn the infrastructure of the business, and then you get out as quickly as possible and go to a hedge fund. If you don't want to go to a hedge fund and just carry on trading for yourself, you can reverse into being your own hedge fund. You can grow into it. The first thing you do is set up what we call a managed account structure, where you manage your own and other investors' money. And you trade that money on power of attorney. So people invest in you. If you get to that stage, just before tipping point 1, and you make money trading for yourself, it'll be no coincidence that lots of people become interested in wanting to give you money to trade with. People will be throwing 50, 100, 200 grand at you from all angles, because you've just proven over the last 2-3 years that you double the money every year. People will want to give you money. So instead of going to the hedge fund, you now have a choice where you can grow into your own hedge fund. What you could also do, and by the way, a hedge fund structure to set up costs about $1 million. A managed account structure costs significantly less, maybe 10, 15 grand. What you can also do is go to an outside investor and say, here's my track record. I want to set up my own hedge fund. And you can give equity in your hedge fund for the capital to set it up. That's possible as well. But let's define the opportunity cost.